So let's finish up with the example that we were just looking at. So let's look at the same information, but from a variable costing income statement. And we're not even going to look at 2 production levels, we're actually going to look at 3. In level 1 we made 20,000 units, in level 2 we made 25,000 units, level 3 we made 30,000 units. We're still going to sell the same 20,000 units. The point of this is going to be to prove to you that your income from operations doesn't change under a variable costing income statement. And the reason being is because you're not spreading those fixed costs over the number of units that you're making. Alright, so you've got same 20,000 units, the same amount you're selling, $75 a piece. That hasn't changed. You're still making $1.5 million in sales. But now the ones that we're selling, if you look at this variable cost of goods sold number, the cost of goods sold is 700,000, 700,000, 700,000. All right, giving us contribution margins here of 700, 700, 700. All right, then we subtract the fixed costs, and if you can tell, they're all identical. And the whole reason, the sole reason, is because the ending inventory, the 5,000 units that haven't been sold here and the 10,000 units that haven't been sold here, do not have a portion of fixed costs allocated to them. Okay? The only thing that is important to take away from this is that the variable costs are the only costs that are included, so fixed costs are not being spread out over a greater number of units, making making cost of goods sold look lower than it actually is. I wouldn't be surprised if you had to rewind me and fast forward me a few times to listen to this a couple more times. But once you start doing the number crunching and when you start doing the homework, you will see that there are the differences between the absorption-based and the variable costing methods. Remember to keep your focus on the fixed costs, because the fixed costs are really what is distorting the two income statements from one another. Okay, so moving along here, different topic. What you can do with this variable costing statements is not just look at the income statements that we're doing here, but we can actually analyze different types of data as well. So what we're going to look at here is I'm going to show you how you can look at, we're not going to focus too hard on the numbers here, but what I want you to do is really just look at this and step back analytically and examine the data that's in front of you. Alright, so let's read through this. Camelot Fragrance Company manufactures and sells Guinevere perfume for women and Lancelot cologne for men. The inventories are negligible, meaning they're really not important. Okay, so here we go. We can look at the data from the Northern Territory selling this perfume, and we're looking at Camelot. Camelot's the name of the whole company. And we've got 2 different types of perfumes and colognes. Guinevere for women, Lancelot for men. It looks like in the Northern Territory they sold an awful lot of Guinevere. In the Southern Territory maybe they sell more Lancelot. And if you're looking at these, you might go all the way down to, you've got variable cost, how much does it cost to make these products, how much is it costing to promote these products, and what are the sales commissions on these products. Now if you just looked at this very quickly, you might say, okay, well they both sold the same amount in each territory, but looking a little closer, the reason that they sold the same amount is because they sell more of Guinevere, they sell a little bit more of Lancelot, so the Southern's balancing it a little bit better, but they're pushing the Guinevere product a little bit harder. Overall, the total sales commissions, you're actually, you're selling the same amount of product. You still have $80,000 worth of product, but in actuality, the Northern Territory is spending more money to promote the items, and it's spending more money on sales commissions. So really the question is, are we making more on the Northern Territory's product, or are we making more on the Southern Territory's product? Right, so something to look at. So let's take it a little bit further. Let's look at the Camelot contribution margin by sales territory. So what we're going to do is we're going to take the data from the previous page, and we're going to say, well, how much are we selling in the Northern, how much are we selling in the Southern Territory? Well, we've got $80,000 in sales. Our variable cost of goods sold is the same. But again, here's where I'm pointing out to you that the Northern Territory has a lot more variable selling expenses than the Southern Territory. So they're making the sales, and they're actually earning more money on the sales than the Northern Territory is. because they've got so many variable selling expenses that are being included. It's costing them more to make the same amount of money. All right, so the Southern Territory definitely comes out ahead here as we take it down a level and look a little bit more carefully. So taking the next step, let's look at the sales mix, which is how are they selling the Lancelot and the Guinevere, and how much are they selling of each? Let's take a look and look at that for a second. So let's see, we're going to examine Guinevere versus Lancelot a little bit here. It looks like Guinevere, you've got 90,000 in sales of Guinevere, 70,000 in Lancelot. And really, your promotion costs for selling Guinevere are quite high, actually. Right? You have to, in order to make $90,000 in sales, you've got $10,000 in variable cost of goods sold, but you've also got $45,000 in promotion and sales commissions that you have to spend. So really, at the end of the day, you're only making 38 cents basically on every dollar of Guinevere that you're selling. You're not making as much money as you are on Lancelot. So Guinevere, you may be selling more of Guinevere. It may be bringing you a greater sales figure. But the idea is that you're making more money on Lancelot because you don't have to spend as much money on promotion costs or sales commissions. All right, now I could make a joke here. I'm a woman, so I can make this joke. Maybe it's because women, you have to sell a little bit harder to women than you do to men. Give you some more bells and whistles and free things and all that kind of stuff. And maybe it's a little bit harder to sell to women. They are expecting more free things and products and such, and men just kind of go in and buy the stuff if they like the way it looks. So just me putting a little bit of my own, spin on it, marketing spin on it. But the idea overall was what you're getting from this is you're realizing that Guinevere, though it brings you in more money, you're really making more money on these Lancelot sales. Okay, and to take it one more step further, let's look at the salespeople and how they're selling the products. Again, we're using the same kind of formula, sales minus variable cost of goods sold, give you manufacturing margin, okay? But we're looking at it by person now, a salesperson. We're saying, all right, well, how much do they make? So we're looking at that Northern Territory. And remember, the Northern Territory is the one that had the larger costs overall in order to sell the product. Now you could look at these and you go, okay, Nez sold $20,000 worth of product, Tom sold 20, Beth sold 40. And you'd say to yourself, wow, all right, Beth's doing great. She's selling a lot. But if you step back for a second and you look a little bit further here, you would see the costs of Beth's sales. She actually is spending $20,000 in variable selling expenses in order to make that $40,000 in costs. Whereas Tom and Inez are only spending $8,000 apiece. So really, they're spending less to make that $20,000. So percentage-wise, they're actually way ahead of Beth. Beth is probably giving away a lot of freebies here. All right, Beth. The other thing I want to call out here is that they are selling half Lancelot. All right, and Lancelot is a better earner for your company, whereas Beth is not pushing any Lancelot at all. She's only pushing the Guinevere perfume, meaning that she's not making as much money on every sale. Okay, so she's spending more in promotion and sales costs, and she's selling the perfume that's not making you as much money. So whereas on the face of it, you'd look at it and say, wow, Beth is really doing a rocking job selling this stuff. Really, Tom and Inez are better earners for you. Your contribution margin higher, the actual amount of money that's going to your pocket at the end of these sales is higher based on what Inez and Tom are bringing in. Okay, so this stuff is not just limited to looking at, income statements. You can take it to these levels and analyze a lot more things than just regular old income statements. Like you can see how a salesperson's working. So if you're running a business, you don't want to just give Beth an automatic bonus because she had the best sales figures. You really want to look at what she's selling and how she's selling it to really determine if she is the best salesperson. And in point of fact, she is not. Right? I hope this chapter helped you start to understand how we're using these tools in order to run our business. All right? Have a great night, weekend, or day.